Hi everyone, this is Finance Meets Real Estate. So we have Rayan Rafay here today. So he is the co-founder of Fraction, and he's going to talk about building a socially conscious solution for finance solution for people as they live and age. So I'm very interested to hear what he has to say. It's an interesting property technology topic. So yeah, we're going to have a recording of this event as well. So for those of you for people who will be listening to it, so our channel on YouTube is Finance Meets Real Estate. Okay, so with that, Rayan, I will pass it on to you. So if any questions or for interaction, we can put them on the chat, or people can speak up. Mm-hmm.
Yeah, for sure. I think that my ideal would be that we can have sort of a question and answer session. So please feel free to sort of interrupt me, I guess, at any time.
Sure.
I guess as it relates to the topic of PropTech, I think it's probably important to really agree on, what does that even mean? And I think that, Rex Salisbury is one of the partners at Andreessen Horowitz, kind of had an interesting post recently where he said that, I've stopped using fintech and I say finance now. And the reason is because they should be synonymous with each other. And I think that applies to a lot of areas, like the difference between pharma or health tech is kind of a fine line. And I think that we're not there with prop tech or real estate and technology as discrete, industries, but you hope to get there to a point where it's all synonymous, right? That there really is no dividing line between traditional real estate and prop tech. But until we're there, I think it's useful to say, what is prop tech? And I think that prop tech is at its core leveraging a lot of the innovations that have happened over the last 20 years towards real estate, because there's just a tremendous confluence of things that have all come together to create opportunities that were really never before possible. And, on one hand, you have all of the built up, SaaS applications and the ability for people to purchase services and offerings at a scale that previously weren't possible at a smaller scale. So, the individual investor now has access to tools that previously a Brookfield or a Blackstone only had access to, and data that those only had access to, and you had to have teams of analysts, whereas you can do that individually now. At the same time, you have a climate change push that results in LEED certifications and all sorts of climate change related or informed desire for eco-friendly spaces, places with lower carbon footprints, and that results in sort of the sensors all over the place, and there's this push to make sure that we're using everything as efficiently as possible, not just from the construction phase to the actual once it's built and the operating phase. And all of that in concert really is prop tech. Now, within that, there's also this financial innovation push. And that's really where I've spent most of my time, is how do you leverage sort of financial innovation in order to have better outcomes for real estate and to be able to offer people better solutions that fit with how people have evolved in terms of how they live and age. And then the natural question is, why now? Why are there opportunities today that previously weren't possible? And on the technology side, I think there's really a couple of things that have enabled many things. One is, I think, Google mapping the earth. Really, really critical. Before you used to have to go to the city and buy these maps and build these permits, and that information is really all electronic today and allows you to do things that really you wouldn't be able to do before. And then the last one is sort of, it's almost overused, but it's very true, which is serverless architecture, AWS. Being able to buy computing power, as you need it, has allowed people to do the types of analysis that previously weren't possible. At my previous company, which was another prop tech startup, we got a couple of patents for how we decision data, But real estate is sort of the ultimate big data problem outside of like DNA and bacteria. And the reason is it's just so diffuse. If you think about the residential market, there's 130 million homes just in the United States. And each of those homes has about 300 to 400 unique fields or variables attached to it. So, we all are used to talking about beds and baths, but there's a whole other litany of things, including foundation and square footage and lot size and grading. And those are all unique to every single one of those 130 million properties. Add to that the US being very data rich, we have transaction history going back to 1960. So you have the sale price and all the other details with buyer and seller of every single home in the country going back to 1960. And today you can go to CoreLogic or House Canary or Black Knight and all these other providers and buy this data if you're willing to. And similarly in Canada and other markets, that data is slowly being opened up, but it's there. And if you think about trying to solve that problem, you take the typical equity market where there's 5,000 listed property, 5,000 listed equities roughly in the United States, or you take AAA, real estate, high rises. New York has maybe 500. And if you look across the country, you're at maybe 1,500, what I would call skyscrapers. It's not that much. It's a very small universe. And it's very easy to get your head wrapped around, the world's largest shopping malls or the world's largest high rises. Residential real estate, not possible. So we wouldn't be here today where we have Zillow and we have Open Door and we have all these other companies and companies then that are building off of what Zillow's done, as I would say the early pioneer, really leveraging the fact that there's all this data and we have the computing power to leverage that. That allows the asset class to gradually become institutional. It allows us to use technology to find solutions that are able to bridge the gap between sort of bricks and mortar property management and getting portfolios of scale without having to deal with the in-person part of real estate. But I want to sort of caveat that by saying you can never entirely get rid of the fact that real estate is in our physical world. It is a physical asset. And so I think that often you've seen companies get tripped up where they're trying to scale, venture-backed, trying to scale rapidly in real estate, and they sort of hit the wall of capital markets, or they hit the wall of it's a physical asset and it does not scale like a software business. When you deal with this space, and you need that physical presence. For example, if you're building a single family portfolio, if you're listing, just a classic real estate website providing listings of which, there's several copycats to Zillow in the US, but also around the world. You have to recognize that really no one has successfully disrupted real estate agents. So it may not be worth continuing to try. And I think in there is actually some kernels of insight on just how people think and how people behave. And specifically what I mean is that real estate agents are helping people make the largest purchase usually in their lives. It's one of the most significant purchases you make in residential real estate. And sometimes you just want someone who you can, look across a table and can help guide you through that process. And there really hasn't been any materially successful example where they have shown scale and successful cost of acquisition metrics of doing this completely digitally. And I think that it just goes to continue to hone that idea. There's also been a lot of companies that have tried to build what you would call a SFR, single family rental portfolio. And then they hit the reality of property management. And property management doesn't scale the way you can acquire assets. You need people in every single city that are going to manage those properties. And there's an economies of scale issue there in terms of a certain number of properties and a certain density in order to make property management feasible. And that constrains you from building fully diversified massive portfolios in the same way as you could with other asset classes. And so there's all these real challenges in the physical that really prohibit you from rapid scale. And the capital markets piece, I guess I'll just briefly touch on and say, real estate is so large. It is the largest asset class in the world. in most economies, it's about 20% of GDP. And it's overwhelmingly, and within all developed countries, it's almost half of CPI or inflation. So when you think about this asset class and its relevance to the economy, there's nothing like it. Everything else is dwarfed by real estate. And that also applies to individuals. If you think about your own individual situation, unless you are in the, 0.5% of people in terms of net worth, real estate is likely your largest asset, and it's likely your largest expenditure. If you think about your monthly budget and how much of your money goes towards housing, it's probably the largest portion of your budget. So at an individual level, it's massive. At an institutional level, it's massive. And at an economic level, it's massive. So I think that recognizing that is really, really important, because if you build a company, you raise 3 million or 5 million as a venture-backed startup, but then you're getting into this game, you immediately have to think, how are you going to be able to tap into capital markets? Are you going to be able to get pension fund money? Are you going to be able to get institutional fund capital? Are you able to securitize it? What is your plan? Because, if you're in most parts of the coasts of North America or any major world city, you're looking at about $1 million a house, 10 houses, 10 customers, $10 million. So 100 customers is $100 million. So you run out of money very, very quickly if you aren't able to reach those deep pockets of capital. Family offices don't have enough money. Ultra high net worth doesn't have enough money. There really only are a few places to go that are able to give you the capital you need. And so if that's not part of the business plan, or if you haven't adequately considered that, you immediately run into challenges. I guess I'll pause there, Stefan, and see if you have any questions or anything, but I can go into sort of the aging piece of it.
Yeah, so actually that's really interesting, very interesting discussion on scale, kind of achieving scale, right? You seem to have a lot of insight in that direction. So just for, if others would agree, some of the things that I picked on. So you were saying at the beginning, so one thing you said, it's actually quite notable. It's an industry for, in terms of big data, right? In terms of purely having the time component and having, this number of properties and having a series of fields attached to them, let's say, right? And things like that. And then, obviously Google Maps and computing power, being able to run computations on the cloud, I assume, things like that, right? So those are some important. So that is a very interesting observation. And then in terms of, let's say, in terms of the physical constraints that you mentioned, so would it be, so constraints to scale, you mentioned property management is one constraint to scale. Is that the only one? If, let's say, somebody wanted in theory to own the most fragmented thing, let's say single family residence homes, and to own a huge, to scale to a big extent, would it be just a property management constraint to the extent that, in certain geographies, it can't meet the minimum threshold for that property manager to operate in, maybe things like that? Let's say there are too few units there, etc. Or would you say what are some other constraints? I assume it's maybe observed by turnkey operators and companies like that.
Yeah, so, and I should say, sort of my context is, I ran one of Canada's largest pension funds, and obviously did a lot of commercial real estate in that capacity, but personally started buying up single family real estate, multifamily real estate in the US in about 11 to 12 years ago, and sort of personally encountered, the challenges of property management before I went on to build Unison Investment Management, where, it's over $1 billion in AUM now, across many U.S. cities. But the challenges aren't just property management. Kind of, I alluded to, there is this personal piece of it, which is real estate is also the most regulated piece of the economy. It's actually more regulated than healthcare, and it's for all the reasons that I was alluding to. Is real estate is actually some of the oldest forms of law there are. Property rights are actually some of the first laws that existed. And if you go to most countries and you look at sort of the most, early versions of law, it was really about how do you decide who has this land and who has that land and how do you control it. And as a result of that, there's a nuance around each jurisdiction. In the US, it's counties and cities that, it varies pretty materially. And it's no different in Canada. Again, North America is my main context. So you have nuances around individual recordings, you have zoning issues, all of this can be quite unique. And that's why people always say real estate is local. Now, data can solve this, but it's a long way away from being able to discern, for example, individual zoning laws and, digesting municipal laws as well as sort of county codes and construction codes and all that kind of stuff. It's still a world that we're in early days of startups attempting that. I know a couple that are trying to. But we're a long ways away from that. So that's certainly one piece of it. And then the last piece of it is the fact that there's a lot of companies trying, and obviously with COVID, we've seen a lot of advancement in terms of a lot states accelerating, for example, recordings. So now you're able to notarize. Most states will allow you to notarize something, over Zoom or some sort of web presence, e-recordings, but wet signatures used to be a big thing, which is you have to physically sign a document with ink in order to get it to proceed. Having said that, you still need local conveyancing, local title, local escrow, and an expertise around those because of all the things we were just talking about. So I think that's one of those issues. And then the last one I would say is the fact that when you talk about how you get things done in a specific area, so not just building a portfolio but creating one, awareness digitally has not proven, in my opinion, to successfully be able to penetrate awareness, especially if you're doing something new. So there's because Proptech is so wide, I'll try to narrow in what I mean. Is Zillow initially attempted to be, a way to replace real estate agents, and they quickly gave that up and said, we're going to sell leads to real estate agents. Open Door is trying to sell homes online and allow people to basically, sell their home before they purchase the next home and have, certainty around their move. A lot of companies have attempted this, but where awareness is challenged is being able to do all of that digitally. You end up digitally with a very leaky funnel in real estate where, you may pay for Facebook ads or paid search or any display. You end up with a lot of leads, but these leads are very low intent. And being able to successfully find customers with high intent, purely and exclusively online is pretty hard. Now, the people that have figured it out to some degree are local mortgage brokers or local real estate agents that just have very specific expertise about what happens in a given community or city. So even though they're doing things digitally, they're doing it with an expertise that is very narrow. But if you think about building an institutional presence or a national presence, that kind of gets challenged.
Right, that's interesting. And in terms of the capital constraints, so what would be the difference there in real estate if one wants to scale capital to, to have like a large institutional real estate portfolio?
So, I mean, there's a lot of consideration. So if I go back to my pension world, right? So the way a typical institution works is they'll do asset allocation, right? And they'll basically say, if it's a pension fund, they'll say, okay, what are my pensioners around? What are my obligations? And what are they going to be over the next, 50 to 100 years? And what are the cash flow streams or cash outflows going to be like? And then let me come back to the present term and think about the ideal asset mix that helps me or gives me the greatest certainty around meeting those obligations. And that's how you end up with, proportion to equity, proportion to fixed income, and within those, niches of emerging markets or frontier or, ACWI, small cap, large cap, and so on. And within real estate, the problem is that it's still relatively new for US investors. Europeans, Canadians, Australians are obviously way ahead of the curve. But real estate generally meant real estate. Most indices in real estate are a commercial measure. So you have office, retail, you have, industrial. and multifamily and hotels have always been kind of a gray zone, whereas it private equity, is it real estate, is a big debate, which I'm not going to bother to get into. But I think that the challenge is residential's been left out, and residential, and multifamily, just to clarify, is typically in an institutional portfolio is 50 units or more. Now, officially, multifamily is more than 4 units, but you very rarely will see a large institutional portfolio with something with 4 units. Usually, you don't see things with less than 100 units. But the challenge is that commercial only represents like 12% of total real estate value. It's nothing compared to residential real estate. But building a residential real estate portfolio is extremely hard, because the things you would do for a commercial real estate portfolio. Yeah.
Commercial, including multifamily, you mean, is 12%, correct?
Yeah.
Yeah.
Yeah. Yeah. Yeah. The world is overwhelmingly, and to be clear, multifamily in commercial parlance means a building, like a build-to-let building, a rental building. Whereas like obviously a high-rise that's titled as condominiums is considered residential, right? Because you can't actually buy the whole building, you have to buy individual units. So it's overwhelmingly the majority of assets, but it's really hard to do. And it's because the things you would do in commercial real estate to make an investment don't scale. So for example, if I'm buying a $100 million high-rise in San Francisco, where I'm based, I'm going to go to the Altus Group, or I'm going to go to someone else and I'm going to get it appraised. I may spend a fair amount of money. I may spend $10,000 on that if I want it done really well. I may have a structural engineer come and look at the building. I may have someone else look at the lease rolls and the tenant rolls. I may have someone who looks at fire and safety. And when it's all said and done, I may have spent easily $300,000, $400,000, $500,000 on due diligence. Now think about that in the context of making a $100,000 investment, or a $200,000 or $500,000 investment. How do you make that scale? And how do you then make sure that you're going to be able to maintain that property? Or do you innovate structures like we've done, in my previous company at Unison, we created home co-investments, which was investing with homeowners, so they took care of the property, or what I'm doing at Fraction, again, which is getting exposure through homeowners. So you create a new structure, you innovate some sort of financial structure where you aren't tasked with building it in the same way as you built a commercial property portfolio. And one of the things then you have to start leaning on is portfolio theory. So for example, a classic advantage of math is that generally speaking, unless you have reasons to believe otherwise, errors are normally distributed. And what that means, right, is that if I'm off on the value of a specific home, I'm going to be off. But if I build a portfolio that's large enough, where I'm off, because I overpaid and I'm off because I underpaid, ends up being a wash. And I've certainly seen that in the portfolios I've built. At my previous job, we built, over an 8,000 home portfolio, and tracked it, over time. And you certainly see that, time and time again, errors being normally distributed, pricing, appraisal risk, all this stuff being normally distributed. So that leans into, how heavily we relied on data science to make these decisions, to enable us to scale. And all of that helps. All of it is setting the foundation for capital markets. But you have to have investors on the other side that are willing and able to invest in these assets. And so if you do it in a conventional way of single family real estate, it becomes hard to scale. And the reason is, again, just the size of it. Like if you look at the largest publicly listed REITs today, or you look at someone like Pretium, Invitation Homes, Amherst, like all these folks are pretty large, Tricon, but even then they're just a fraction of the market. The largest portfolio may be 50,000 homes. And they have to build that concentration typically in places where you have a positive rental yield. In most of the places that appreciate the most in residential real estate, and this is globally true, you don't have a positive rental yield after you adjust for financing. If you buy a property in San Francisco or New York and you try to get an 80% or 70% mortgage on it, you're not likely to generate very much positive cash flow from just renting it out. And so the returns are typically weighted towards property appreciation. And then there's the places like the Southeast or the Southwest, like Atlanta and Memphis and Nashville and Cleveland and Columbus, where you actually get a positive rental yield because the cost of financing it is less than the rental yield you get. So it caps you in that way as well, if you are income seeking about trying to find a portfolio and trying to find the appreciation. But you know that if you were in San Francisco and in New York, you would do a lot better off over the long term. So that one of those considerations is, are investors going into single family real estate because they understand that it's the largest piece of inflation? And so if they're exposed to inflation, it's an inflation hedge? Or are they putting it into their private equity bucket or their alternative bucket and they're expecting a 10 or 12% IRR? And if they're expecting a 10 or 12% IRR, how are you going to deliver that in the places where appreciation is actually pretty strong, unless you're constantly turning over your portfolio, and then you have to factor in all of the friction in residential real estate for turning a portfolio over. And so you have to have institutional investors that are potentially willing to take lower returns, potentially willing to take more returns coming in from appreciation rather than income, and having a sense of how you're able to scale it efficiently, right? Like if you talk about institutional investors, you can't really charge more than 1 or 1.5%. But if you think about all the fees that could be associated with real estate, you may end up at 5 or 6%. And then you have all these committees that they don't even care what the asset is. All they care about, and there's a liability, there's fiduciary obligation and liability for the people that sit on these investment committees to say, I don't care what it is, I'm not paying that much in fees. And so those are some of the things that capital markets are just gradually getting accustomed to. But if you look at the allocations that are explicitly for residential real estate, there's still a tiny fraction of what they ought to be, relative to the size of the asset to GDP, relative to it in the economy, relative to it for inflation. And that's where the innovation in structures is really critical.
So you're saying, like, in terms of from a total return of real estate perspective, it actually, like, it's a bigger appreciation is the predominant component, broadly speaking, due to, like having all these markets where rental yield does not exceed the cost of financing. So it's essentially it comes down to sort of transaction and sort of efficiencies of the being able, like having institutional investors being able to turn over having an exit, let's say in 5 years or whichever time, but sort of in an efficient way that they don't burn out sufficient transaction funds, etc., transaction fees, etc. So it actually boosts the appreciation component, which is the biggest one of the total return, and sort of boosts the total return overall. Is that kind of your argument in that sense, or am I missing?
Yeah, I think it's sort of a very loaded issue in terms of institutional investors looking at it. I think about real estate as I think about stocks, if this makes sense. There are stocks that pay dividends, and there's stocks that you get your return from growth. Typically, the ones that offer growth, certainly more critically over the recent terms, tend to have higher returns. And if you think about the cities that are producing GDP, the cities that are really growing, those are the places where you see a lot of that appreciation coming from growth. And I do want to make a nuanced point, which is cities are not the same. Let's take New York, just because most people understand or have been to New York and see it. Manhattan is very different than parts of Queens or Brooklyn or Staten Island, but if you think about it as a metro, it's all the same. And so where you invest in New York and how you invest is equally critical. If you bought a bunch of the Hudson Yards, which are ultra high-end condos, you'd be probably down 30% right now from when they were first built. And if you were investing in Brooklyn during the same time period, you'd probably be up 30 or 40%. And so, being really thoughtful about diversification, it's not just cities, it's property type, it's the neighborhood. Like, there's a lot of considerations that go into it. And again, because real estate is so diffuse, it's important to note that, there's parts of San Francisco that have more in common with downtown Seattle, where it's beside Amazon and Starbucks headquarters, than it is in common with a place like Richmond in the San Francisco Bay Area or the Marin County, because they don't have the same access to the same jobs in the same areas. And so there's a lot of consideration to building a diversified portfolio, and institutional investors are starting to think about that. The other piece of it is institutional investors have this dilemma, which is Americans inherently want to promote home ownership, but if your structure is boosting rental supply, which is in another way taking away, purchase supply, then you are sort of acting against home ownership. And so that's why, the companies that I've been part of have not favored that approach of just buying single family rentals, because of you actually exacerbate the home affordability problem, right? Is if you have institutional investors that think about the country as a whole, they're able to pay a fair bit more than individuals. And I think you end up with a lot of potential headline risk down the line, not to mention, a lot of the stories with single family rentals about how they've treated people very poorly pre-COVID, in terms of evictions, in terms of making it a business rather than the mom and pop landlords that dominate the economy even today. And I think that there's a lot of risk there for pension funds or others, institutional investors, in terms of the social risk. And so if you aren't addressing the ESG angle, I think you just have to be thoughtful about how does what I'm doing fit into socially responsible investing. And it doesn't have to be explicitly socially responsible, but how are you going to approach, and I've had to deal with this personally, is a woman who lost her job in a home I owned as a rental, a month before Christmas. Am I going to kick her out? Am I going to evict her? I have every legal right to, right? But am I going to? And because, candidly, it's a side portfolio for me, no way I'm going to do it, right? Because I don't want to live with that. But if you have to deal with those situations and you're an institution and you're relying on policies, it's much easier for us as humans to hide behind policies that our employer wrote than when we are personally making that decision, right? And so there's been a lot of moral hazard where you've created bad actors that have either exacerbated homelessness. There's neighborhoods where you have a lot of single family rentals where maintenance isn't as good as it was if everyone's an owner. And so these are all these sort of other issues that an institutional investor is looking at holistically and saying, clearly we have to be in residential real estate, like you've won me over, but how? And that's where it becomes pretty challenged. And then it's, well, if I'm going to do this, I want a higher return because I'm taking all these risks. And that doesn't really fit well with the fact that residential real estate has access to the cheapest financing in the world, right? There's nothing cheaper than getting a real estate backed mortgage.
Can you elaborate on the part where you said that, so in portfolio theory, okay, we have errors normally distributed. So what was your parallel in real estate? Let's say if we take single family residences, how does that fall apart there, essentially?
Oh, no, I'm saying it's one of the biggest assets you have is that because they're so diffuse, because you're going to build a portfolio that's so large, you don't have the risk. So in commercial real estate, you take a typical commercial real estate fund managed by a Brookfield or an Invesco or JP Morgan, you may have 20 to 30, AAA Class A buildings. You don't have the room to be off on what you pay for those properties. You got to be really sure about your tenant roles and about everything in order to invest in that property. And it becomes very much an exact science in your DCF model. When you're building a portfolio of 1,000 homes, you can kind of be off on the prices. If the appraisals are off, they're likely, unless you bias it in some way, to be normally distributed, and that you may overpay for certain properties, right? And you may underpay for certain properties when you mark your portfolio a quarter later or 2 quarters later. But as a holistic portfolio, you'll be fine. And that tends to be the case also when you're doing like sort of attribution analysis, right? Of if I have a portfolio of 50 homes in Memphis, am I doing similarly to Memphis as a whole or not? In terms of attribution analysis by city, that's also where you tend to see, in a specific home, you may be way off, but generally once that portfolio gets statistical significance, you should be able to track the market. Because it sort of all just comes towards the mean. And I think that's an advantage in residential real estate that's pretty interesting. I think the key thing there is data scientists and quants, if you will, have only recently entered real estate and are still not the dominant group of people. Most real estate people are still, and I don't mean this pejoratively, are hard hat people, which is, I need to go see the property, I need to go experience the property, I need to understand the foundation, I need to see what the construction is like, the blueprints. That's how most people in real estate are wired. And the only point I would say is it doesn't work for residential real estate if you're trying to build a portfolio. It absolutely can work as an individual trying to build a portfolio, but it does not work as an institution. There's no way you can build a portfolio in, residential real estate without applying quantitative methods.
Makes sense. So then for that, how would you say you optimize sort of like risk adjusted return for a portfolio, let's say in real estate, where you have, let's say, several assets, and you have their returns distributions, you have their volatility distributions. How would that work in real estate from your perspective?
So real estate's really interesting because real estate doesn't have as much downside risk as any other asset. And the reason is very simple.
Yep.
It's the largest asset in most people's portfolio. If governments ever let real estate fall for a sustained period of time, the economy's done, right? It's done. And we saw that in the Great Depression. And we've seen in 2008, and we've seen during the COVID crisis, that central banks will do whatever they have to provide some sort of support to residential real estate. And allowing mass foreclosures or mass defaults is not in the cards, and it doesn't help anybody. So acknowledging that, if you have a portfolio that's diversified enough, you don't really have long-term downside risk. Your only risk is timing. And so I think that risk is a little bit different in residential real estate. And it allows for an opportunity in real estate that when you couple that with this fact that you have access to the cheapest leverage there is, you don't take as much risk as you would otherwise. And I'm not, and to be clear, I'm like, there's a lot of real estate that's very risky. There's a certain amount of leverage that's too much. Individuals, obviously, that are trying to buy a house for themselves always have to factor in the monthly payments and their own liquidity and all that. So not trying to suggest it's riskless, but as an institutional investor or as an investor who's building a diversified portfolio and thinking 5 years or 10 years out, short of some sort of revolution, sort of world wars, things that can debase the currency overnight, things like that, it's about as safe as it gets for that reason. Is what trigger, like what I asked myself is, what would cause this asset class to fall, and would central banks, would elected officials allow that to happen? And what chance would they have of getting reelected or staying in their position if they're, facing the prospect of 20% of homeowners losing their home? And it's always important to remember the context. There's 2008 being arguably as bad as it gets, but if you look at the worst prime residential mortgage-backed security portfolio, the worst one, and by prime I mean 680 plus credit scores, the absolute worst one had a 5% default, right? That was as bad as it got when all was said and done. Now, there was obviously a lot of lending that happened to people that shouldn't have been lent to, and there's ethical issues, and laws have come out as a result, and the CFPB was created in order to prevent that from happening again. But as an institutional investor, you think back about that and you're like, that was one of the worst crises that we could see in real estate. It was a real estate fueled crisis, and we had a 5% loss on our portfolio. If that's your downside, then it's not bad.
Okay, but as an institutional investor, what would you say is your measure of risk? Would you say price volatility in real estate works as a measure of risk? Because I'm not sure about that one. The downside dynamic and the overall price dynamic, it seems different than finance.
Yeah, I mean, I think your biggest risk is timing and liquidity, right? Like those are the, like, what could be the worst that happens, especially if you're a commercial portfolio, is you're just going to sit on your portfolio. And that's what a lot of people are experiencing right now, right? I mean, if you have residential real estate, it's shockingly hot right now. But if you have office or hotels, you're sitting on them. You're not able to sell them, and you're not going to be able to sell them at a mark you want. So if you have liquidity considerations, I think that's the biggest consideration. And I would just say, I've done a lot of work on this. The illiquidity premium is one of the hardest things in finance to really conceptualize. Like, how much should you be paid for taking liquidity off the table? You know, how much should you be paid for illiquidity? When you compare it with private equity versus equity, you compare it with venture capital, you compare it with, you know, publicly listed REIT versus a private REIT. There's been a lot of academic papers on it, but no one's really come to a decisive, or I would say compelling, conclusion on how you factor that risk. Personally, make it very simple, which is what have the returns been of like privately listed REITs versus public REITs? The NACREIF Odyssey, you know, versus some of the many REIT indices. And we say, okay, that's a effective measure. And then you can take things like, you know, Sharpe ratio. I think Sharpe ratio works very well for your portfolio versus like the Case-Shiller for the area or for other areas, you know. And then the way I look at risk, the number one thing I look at risk is correlation or co-integration, which is how does my portfolio move together, right? And that is really, really important for your home versus the city it's in, and your home versus the national market. So if you build a portfolio of homes and they are not co-integrated, I think you're taking very low risk. If you're building a portfolio of homes and they're highly co-integrated, and let's just give a very obvious example, right? If you have a bunch of student housing in your portfolio and they're all beside state colleges, they're going to be very highly co-integrated, which is to say that they're affected by the same factors. And in a down market or in an up market, they're going to react very, very similarly. And that is, I think, the biggest measure of risk is how co-integrated or how correlated is your portfolio. And there's a number of sort of dimensions you can look at it.
But okay, but let's say if we take just focus on one component, let's say we take Sharpe ratios, and that's actually an excellent point you made on illiquidity premium, and that's I'm sure that's especially difficult to model. But then like if we Sharpe ratio though is a pretty simple measure, right? You just have the volatility, price volatility, and price returns. So that's all that you need there. Like, would you say that works? Let's say, would you say if we take at the state level, let's say we take California, and then we take Vermont, and then we take some of the poor states, let's say, I believe I was seeing favorable. I mean, for example, volatility is exceptionally low in some of the poorest states. We have Mississippi, we have Louisiana, you know, like some of those places, actually price volatility is exceptionally low. There simply aren't transactions that get factored in there, it seems, right? So that's on its own, I believe, is a different dynamic than finance, where you have, if you have a not so desired stock, it might though be volatile. Well, in real estate, okay, it's a different dynamic. It's not the least desirable places in the United States, let's say, but they're in fact the least volatile. So is that sort of a plus to them in Sharpe ratio space? And then if you rank Sharpe ratios, I think I did like a high-level study of that, and then I was seeing, okay, some of the poorest places are on top, and then there's some others too. You know, some of the richer places are also on top, but it's sort of, it wasn't very intuitive. And then I was thinking I should probably normalize by a series of factors. You should take out like the genuine, you should take out like components of when a bubble happens, for example. Like you should take out the overvalued component and then maybe just look at purely that or etc. Or, you know, it's just, but I wasn't finding it like very useful. So I'm saying, so what would you say are very favorable regions in Sharpe ratio terms, for example? Would you say there are such, let's say from a pension fund standpoint, institutional investor standpoint, they should know, right? They should know, okay, those are sort of blue chips in real estate. Those are like regions that are exceptionally strong in risk-adjusted terms. So what
it's a really good.
Yeah.
Sorry.
Mm-hmm. Yeah. So like, what are they?
I think it's a really good point. I think there's a few things to consider. One is that real estate is, and this is sort of a really hard topic to address, but real estate is not sort of one for one. And specifically what I mean is that if you take the areas that have the most demand, we're used to, and the way real estate values these properties is the price per square foot on what is built on the property, What it kind of misses is what has been happening in any major city around the world over the last, well, forever, which is densification. So, if I'm able to build on one lot of land and I'm able to build 5 times what I had previously, because now I can build a 20-story building, inherently it's more valuable. But the way we measure real estate actually misses that entirely. It misses the appreciation potential. And when you look at that, and you look at like for like in terms of what happened in New York or San Francisco or LA over the last long haul, that shows you that the volatility is overwhelmingly towards the positive. But to your point, you will have in the long term more returns with more volatility in real estate for sure. Hudson Yards and what we were talking about with Manhattan's a great example. Manhattan's had so many ups and downs, whereas Alabama or Mississippi are much more stable. But I think the other factor that is often missed as well is property taxes and their role in the more volatile your property taxes, typically the less volatile your home prices. And that's kind of counterintuitive. California, for example, has a very stable property tax regime. And as a result, the property prices are actually more volatile. And it's kind of the opposite in states that aren't as well funded. And so property taxes can't entirely be eliminated. There's sort of an economic rent, that acts against sort of the natural asset or the natural, supply and demand for properties. And I think that's one consideration. But I would say that, the places that don't have volatility, it's your classic private equity type of play, which is you go and find these businesses that aren't really growing stable cash flow and you lever them up. And you wouldn't do that to the same extent in places that have a lot of volatility or businesses that have a lot of growth. And in that same way, you should be pretty comfortable taking a lot of leverage in those stable markets, but less comfortable taking as much leverage in those fast moving volatile markets, unless you're doubling down, obviously. And then the last piece on the volatility comment that I think we also miss is if I'm buying a house and I'm putting 20% down, I have 5x leverage immediately, right? And I think the behavior of that leverage is often missed when people compare it to, buying equities or buying bonds where you're buying 100% of the asset. Leverage is more common in real estate than it is in practically anything else, with the exception of infrastructure, where you often say 90% or 95% leverage. But the influence of leverage, the influence of interest rates, really can't be missed. And that's probably the place that you capture most of the volatility is, what is your interest rate exposure and how much leverage are you taking?
Mm-hmm. So why would you say that, so let's say, given all the protection that especially residential real estate has, let's say in the workforce space, upon an economic downturn, why would you say at the beginning of COVID, the stock market sort of reflected expectations of a downturn in also residential real estate investment trusts? There is one that, at least one that, one of the ETFs that identifies purely the multifamily space.
Yeah, the sort of stock market dynamics, I think, are a very different conversation, just because, I'll just give you my personal view, which is I think that, as far as equity investing, and I started off as an equity trader in Hong Kong. That was sort of my first job with HSBC. I think the equity markets are now, a majority passive. And so they're reactionary. The majority of markets are not, they're not intelligent analysts sitting there making prices. And so what you saw in March, in my view, is largely driven by fund flows, which was ETFs being sold out, people going into cash, people hunkering down. And as a result, they had to sell their equities. They had to sell whatever positions they had. And as you saw, some stability, but you saw stimulus payments and you saw a variety of other efforts, it went the other way. And it wasn't really informed, in my view, by someone saying, I think real estate is going to do poorly now. It's more purely people were cashing out and cashing back in. And as soon as people had nothing to do, you obviously had a lot of speculation. a small group of active investors or a small group of retail investors can massively change markets, because then you have this massive flow of ETFs or passive money that just follow whatever they'll do. Like obviously, I don't want to take us on a tangent, but GameStop is in the Russell 2000. Any index fund that owned the Russell 2000 had to legally buy GameStop as it went up. They don't really have a choice because their down performance is tracking error. And so when index funds have to make purchases and they're going to follow a small group of investors, it's honestly no different than what I witnessed in my own career in Asia. And in Asia, what you had was, very small free floats for massive companies. So you had a small amount of shares that hit the market, but huge market caps. Take ICBC, one of the largest banks in the world, but it's overwhelmingly owned by the government of China and other state-owned enterprises. So there isn't a lot of free float in the market every day. And so retail investors completely change the market caps on a regular basis. And that's why there's this disconnect between the H share market, which was in Hong Kong, and the A and B share market, which was in China. Same thing in Korea, same thing in Taiwan, same thing in India, where retail investors, basically cause wide swings. And I think we're just seeing that happen in the US for different reasons, which is more passive money. But I don't ascribe any sort of fundamental insights into real estate from that movement.
Okay, thanks.
Yeah, so I guess is it helpful for me to briefly touch on sort of the age piece of this, or?
Yeah, absolutely. Go ahead.
Sure. So on if we focus then into the segment of people that are aging now, you have obviously the baby boomers and everything that's been said about them, but you have the population that has experienced the most significant rise in real asset prices over a generation ever. And as a result of this, they have the most money, but they're also in a retirement crisis. And it's because they don't have their savings in the places that people ordinarily would, right? Which is, if you go back 2 generations before the baby boomers, most people had pension funds. You go back 1 generation ago, it was more of an even split, but more and more of people's net worth has gone and become more and more of their home. And the main driver of that, which is a separate topic, but I wrote a white paper on it, is inflation in 1983 decoupled, and it went away from home prices. So inflation doesn't capture how much homes cost. And it actually is the root of a lot of inequality in the US, and in Canada did the same thing. And what I mean is that people's incomes are based on inflation. Most average middle-class workers' incomes are based on CPI. And the problem is that CPI is used for most government budgeting. So over 50% of the US federal budget is based on inflation. It's hard. And so how do you help fund that? And so in our case at Fraction, we've just really innovated on a reverse mortgage where we provide people the ability to take money out of their home and then pay an interest rate that's tied to appreciation. And the benefit for the homeowner is, of course, the interest rate can be very low, but if it goes up, it's never eroding your equity. So if your home is going up at 5% a year and our debt is going up 5% a year, at the end of the day, if you took 40% of your value of your home out, you still owe 40%. And that was really important to us versus eating away at someone's equity. The socially responsible angle of it was very important. But on the institutional side, or on the investor side, what we've created is a very efficient synthetic exposure to home price appreciation. And so that allows us to target investors in a scalable way, because it's still the homeowner's home, still a mortgage. And you don't really have to get into the nuances and the structure and the scale issues with actually owning and managing a property, which I don't think most institutional investors really have the appetite for. And very limited people have shown the ability to scale. I mean, the only one I can think of is Mind Property Management, MYND. But other than that, there's very limited examples of that. So I think that is where I think a lot of innovation can come, which is how do we help people as they live and age, particularly post-COVID, where assisted living facilities or senior homes are a lot less appealing. And we have sort of multiple other changes occurring, which is You have more multi-generational households, which we've seen in other denser parts of the world coming to North America. And it's really a function of density, right? Is if you have a high cost of living and you have a difficulty in acquiring new property, then you make your property more efficient, and you can do that by building more on it, or you can do that by housing more people on the same piece of property. And I think we're seeing a lot of that, whether it's what you call ADUs, accessory dwelling units, which are like laneway homes or building something on top of your garage. We're also seeing a number of startups that are trying to focus on this social component of it, which is that seniors often are leaving their home or selling their home, not by choice, and sometimes not even due to financial reasons, but just because they can't physically maintain the property anymore. So there's others saying, okay, well, what if we took young people that are looking for affordable housing and discounted heavily the rent and allowed them to have a room in a senior's home, and in exchange for that low rent, they help them up around the house. What if we do that? And so I think there's a lot of innovation that's starting to come in this area. I think it's really high time for it, because most prop tech and fintech innovation has been focused on younger people, on the millennials. Whether it's actually about getting a home, it's actually about accessing home affordability and buying a home. And we've ignored the people with the most money and the most complicated problems. And the interesting thing that links both of these is that if you look at the data, the majority of people that buy a house under 30 have had parental assistance. And linked to that is that people are older and older now than ever when their grandparents or parents pass away. More often than not, now you have people who are approaching being seniors when their parents pass away, and similarly grandkids who are actually in the workforce. And so when they're getting this inheritance or whatever it may be, it's often at the point where it's very directly linked to home affordability or home ownership issues. So I think there's obviously a lot to talk about there, but I'll leave it at that.
Specifically, so let's say if we narrow on like one specific way you guys direct this problem of basically insufficient solutions for that bigger, like wealthier sort of component of the population in housing space, wealthier, and etc. That also needs like better retirement solutions, etc. So what is like one specific product you guys have to help like solve problems in that space and innovate? Just for like our listeners to kind of understand.
Yeah, I mean, I'm happy to walk you through our core product at Fraction. So our core product is, senior has a fully paid home, and we're able to, $1 million house. We're able to give them $400,000 with no monthly payments, and the payment is basically home price appreciation, and that's determined sort of at the end when they buy us out or sell their home. And that is giving an investor exposure to home price appreciation. And for the homeowner, it's giving them access to a rather large sum of cash that they are able to use to reinvest, either by buying another investment property, either by investing in a fully diversified portfolio, or doing something else. But critically with no monthly payments, because often these are people that are asset rich, asset concentrated usually in the home, but not income rich. There's not a lot of cash flow coming in. And so if you're able to supplement that through investing, you take that 400,000 and you can, relatively safely get a 5% return. If you're able to do that, you're immediately adding roughly $2,000 a month to your cash flow, which is huge, for that segment. And can be the difference really between a comfortable retirement and really struggling or having to move in with family or something else.
Got it. Do you guys have questions? So essentially you would offer them to kind of tap into their equity, like extract a portion of their equity as cash without any interest payments, and sort of forgiving the appreciation that they would otherwise receive.
Yeah, and so I should note, I guess, for folks that aren't in the industry. So reverse mortgages have been around for a long time. Reverse mortgages are similar. The difference is that their interest rate is often tied to LIBOR, and they can be quite high. Interest rates even today are about 5%, and they can go up to 8 or 9%. And so they're actually gradually eating away at the homeowner's equity. Our goal is to try and avoid that. By design of not taking away homeowners' equity. And then there are home co-investments, which is my previous company, Unison, where it's truly equity. And if we're talking finance, it's actually an in-the-money call option on real estate. And that is where you get a disproportionate appreciation share. And so in that, and there's a lot of companies like that. There's Unison, Point, Noah, HomeTap, and a variety of others. What they do is, in that same example, they would give you, $100,000, and in exchange, they would share in anywhere between 30 and 45% of the change in price. And that's the levered structure of it. Mm-hmm. So our product is a little bit different in that, and it's also explicitly debt, where those are more, they're truly equity products. And the reason that we structured ours as debt is linked to sort of our very early part of this discussion, which is we have a direct path to securitization. We have a direct path to scaling it. Whereas if you are equity, you have to raise investment, capital commitments. And raising capital commitments for a product that doesn't have any income naturally and has a long time horizon is much more difficult. And by difficult, I would say it just takes time. And that time to get a capital commitment from a pension fund could be 3 years easily, and that often is at odds with trying to scale a venture-backed company or trying to scale something very quickly.
Mm-hmm. Got it. So in the case of is it Unicent, like the company you worked for before, like that you mentioned?
Yeah, I was CEO, CFO, and Chief Investment Officer at Unison. Unison was backed by RBC, Citibank, and a variety of others. And we scaled it a fair bit. And but I think the challenges of continuing to build that capital, so we went over $1 billion, but getting from $1 billion to 100 is a challenge.
So let's say when we make the analogy to a co-option, right? So in the money co-option. So what would be the typical term there? Like what would be the maturity?
30 years.
For 30 years actually.
Yeah. So, really paralleling the mortgage market. Now, for fraction, our product is really renewable. It depends on the geography, but anywhere from 5 to 10 years. And then the idea is you would renew it, and we would be there offering a renewal in order to extend it. But having a term that is shorter makes it even easier to securitize or leverage debt.
Mm-hmm. Okay. But in the case of like the co-option kind of structure, so it's like a
30 years. Yeah.
And you essentially pay the sort of the equivalent of the option price to the option premium you pay to the homeowner at time 0. And then you realize the sort of the maturity cash flow at the end of the term, at the end of the 30 years.
Yeah, effectively, yeah. And, it's important, I guess, to note that prepayments of mortgages are actually very predictable. Prepayment behavior doesn't really change over time. The Security Association created a curve for prepayments back in the 1920s, and it really hasn't changed. So, the average American will spend about 8 to 10 years in their home. And that's pretty much the range of it. In hot times, people will be in their home around 8 years, and slow markets or lagging markets will be more like 10 years. So prepayments are actually quite predictable. And that allows you to infer, how much will turn over, how much cash you can return. But not having contractual income in a structure can be challenging for institutional investors if you're getting money from pension funds or others. They're really fixated on real estate means yield, real estate means cap rate. And if I'm not getting that, then this is not really real estate.
Mm-hmm. Got it. So we have a question on the chat. Well, I guess you kind of answered that for fraction. Like, is there a term? Well, is there a term until they pay you back? I mean, it's more like how your payment is structured, right? So it's so the term you said it's shorter, like the term for the fraction mortgage, so to say, is like 5 to 10 years, right?
5 to 10 years, but critically, by design, renewable in a very, straightforward way. It just, the real practical reason is it allows you to tap a lot more debt than you would otherwise be able to do. Very few funds have the duration or the time horizon for beyond that. But you can, there's a number of things you can do to make sure that that customer has certainty that they'll be able to renew.
Mm-hmm. But that's the amortization term is also 5 to 10 years, or just the loan?
Well, there's no amortization, right? It's a negative amortization.
Okay, yeah, okay.
Right.
Okay.
Yeah.
Yeah, I mean, negative amortization or whatever, they get the payment up front.
Exactly. Yeah, and no monthly payments. Yeah.
Yeah, okay. Okay. Sounds good. And do you have, let's say, other insights you want to share with our audience? Anything you wanted to talk about in terms of?
No, not from my side. I mean, if there's other questions, happy to answer them. But yeah, otherwise, nothing for me. Okay, so that's that was a really interesting overview. I wonder, what are your sources like? Do you, for like getting all the kind of histories behind and like proportions of people investing, sort of proportions of sort of, how to say, like US population components, sort of components of real estate investment and things like that. It's quite interesting. I would say like intelligence framework, I would say. So I wonder, like, do you have like some books that guided you on that? Like, is it more like of a pension fund expertise, the pension fund expertise you had? Like, what are some of your main inputs to having this the views that you have and sort of the framework that you presented here? Yeah, I mean, I think so. The approach to asset allocation, let's call it that, is
right.
Purely from my pension fund background, which is, I managed a multi-asset portfolio, and you think about things holistically, naturally, when you're sort of running a pension fund. As it comes to sort of real estate specific data, CoreLogic is sort of where we used to purchase our data from, and that's the transaction data. And so, I mean, that's a wealth of data. You can go to Unison's website, and there's an investment blog that has white papers and stuff that we've written, but we were looking at things in a way that, really no one has before. But there are a lot of others doing that as well. House Canary is one of them. Zillow's blog is one of them. And then, of course, there's the Urban Institute, which I would say that if you're interested in,
like House, what was the first?
House Canary.
House Canary, okay.
Yeah, so House Canary, Black Knight, Zillow, they're all, I think all, House Canary is not public, but Black Knight is. They all have a very rich source of data. And then Urban Institute is probably the richest source of residential data. Lori Goodman is the head there. She's just brilliant. She used to be a Federal Reserve governor. She used to be a professor at Stanford. She actually may still be a professor at Stanford. But they publish a monthly chart book, which gives you, deep insights into the U.S. market. And then there's a variety of people that I think have good commentary, including Mike Del Preet, who covers Open Door and Redfin and OfferPad and those types of companies. And then, yeah, it's kind of like trying to combine it all. But I would say that being naturally an equity investor, I brought a approach that we used for real estate or fixed income to residential real estate, and that just brings a different framework. but you also realize very quickly that you can become very impractical very quickly. You know, the minute you have 3 property managers or a leaky pipe or something, things become very real. And so there's always this balance that's required in real estate, where you know, you can go full quant and sit there writing models and all that, but it's so important to never forget that it's a very physical asset.
Great, really impressive stuff. Thanks, Rayan. Really appreciate it.
Yeah, thanks for your time. Thanks, everyone, and take care. Sorry about the internet connection issues.
No worries at all. So if you want to share like how people can reach to you,
sure. LinkedIn or our website is fraction.is. So fraction.is. And then on LinkedIn, and then I do write for Forbes from time to time. So I'll probably do 6 or 7 articles a year.
Okay, perfect. Thank you so much. Really appreciate it.
Take care.
Thanks everyone for joining. Your patience. So thank you. Bye-bye.
Bye-bye.